If you've been thinking about investing in the stock market, chances are that people have told you to just put the money into an index fund. And I know you work hard for your money. I also know that it may have taken you months or even years to save the money you have. And that's why I want to make sure that you don't risk losing that money by blindly investing in the S&P 500 index. Imagine saving $10,000 and then you realize, hey, I don't want all this money sitting in a bank savings account. So you look at ways to invest that money. And through Google searching and watching some YouTube videos, you figure, hey, the S&P 500 index is the right way to go. And so you open a brokerage account and you drop your $10,000 into the index fund. Then over the course of a few years, you just see the value of your account getting lower and lower until finally you see that it's dropped below $5,000. Can you imagine the anxiety you would feel? Well, for some people, this was an actual reality. People who invested in the S&P 500 index in 2007. From October 2007 to April 2012, the value of the S&P 500 index dropped 55%. So although a bunch of people on the internet tell you to just put your money into an index fund, in this video, I want to tell you some things you should consider so that you can consistently grow your money while protecting against the inevitable drops in the market. Let's get into it. Hi, I'm Craig Bailey. I am a licensed financial advisor, and I created Financial Seeds to give you a Bible-based approach to financial freedom. And before I get into it, if you find any value in this video, please just take a second and tap the like button. So together, we can help this video reach more people and hopefully be a blessing to someone else. Now look, I know it's not easy for everybody to save up $20,000 or $10,000 or even $5,000. So before you invest a dime of your hard-earned money, I think it's always important that you understand the good and bad associated with making an investment. And I also know that you having wisdom and understanding of how things work is worth a lot more money than me just telling you what to invest in. And that's why the Bible continues to stress the importance of wisdom over and over again. Like in Proverbs 4:7, it says that the beginning of wisdom is this: get wisdom. Though it may cost all you have, get understanding. And in Proverbs 16:16, it says, how much better to get wisdom than gold? To get understanding is better to be chosen rather than silver. So by the end of this video, may God bless you with the wisdom you need, not only to grow your money, but also to protect it so that you have something to pass on to the generations that come after you. You see, all investing has the potential to lose money. And unfortunately, too many people online make investing in the S&P 500 index seem like a magic wand. Like you can just invest your money there and it just continues to grow for the rest of your life. That's not reality. And for those of you that are new to investing in stocks, this is what the S&P 500 index is in like 30 seconds. It's a fund that holds shares of the 500 largest publicly traded companies in the United States. So when you invest in the S&P 500 index, you're in essence buying shares in America's 500 largest businesses. Now I want to break down some of the risk associated with investing in an S&P 500 index fund and then also give you some strategies to protect against those risks. The first and most obvious risk is that you can see drastic drops in your account value. The example I gave you in the intro of this video is just one of many times the S&P 500 index has dropped double digits. From September 2000 to October 2006, the index dropped 47.41%. So if you invested $10,000 in the index in September of 2000, 6 years later, you would only have $5,259. And from February 2020 to August 2020, the index dropped over 33%. Most people can't stomach seeing their account go down that much. Humans naturally have a behavioral bias in which individuals tend to experience more emotional pain from loss than emotional pleasure from an equivalent gain. And this causes most of us to end up selling at the wrong time when we really should be buying. But there is a way to have less stress when your investments drop. Instead of blindly investing in the index, it might be better for you to invest in specific industries that you understand and that you think are growing. And notice that I said industries, not company. I believe only full-time investors should invest in individual companies. And I think individual investors could invest in an index, but they also can invest in industry-specific funds. And here's what I mean. There are only two ways you can lose money in stocks. One is that a company goes bankrupt, or two, you choose to sell your investment for less than you purchased it for. If you don't invest in individual companies, you eliminate the possibility of your investment going bankrupt. When it comes to investing in industry-specific funds, you can invest in wind energy or cloud computing or food and beverage, pretty much any industry you can think of. And if you visit etfdb.com, you can research different funds by specific industries. Investing in industries that you know will make it easier to hold your investments when times get tough. Peter Lynch is one of the most successful investors who ever lived. His fund averaged 29.2% returns from 1977 to 1990. With this rate of return, you would double your money every 2.5 years. And in his best-selling book, One Up on Wall Street, he also suggests investing in what you understand. One of the major themes of his best-selling book is to invest in what you know. Unlike investing in individual companies, if you invest in industry-specific funds, the only way to lose money is if you choose to sell for less than you bought it for. Indexes and industry-specific funds can't go bankrupt. If a fund does close, the money is just returned to the investors. The next big risk is that you have a false sense of diversification. While it sounds good that the S&P 500 is invested in 500 different businesses, the reality is that when you log into your account, you're going to see one value. And part of the psychology of diversification is that you are able to see more investments move up and some investments move down, so that it gives you a little bit of peace of mind. So instead of being totally invested in an index fund, maybe you can put some of your money into real estate, or maybe you put some of your money into bonds. Just like you can invest in a fund that covers the overall stock market, you can invest in funds that cover the overall bond market. Funds like the Vanguard Total Bond Market ETF, ticker symbol BND, or the iShares Core US Aggregate Bond ETF, ticker symbol AGG. Both bonds and real estate prices move up and down less than the overall stock market, so this will help reduce the risk of loss of principal. And the Bible in Ecclesiastes also reiterates the importance of having diversification as a part of your investing strategy. So this is some good information that I found on the Financial Samurai website that gives you a better idea of what I mean about this diversification. From 1926 to 2020, if you were 100% invested in stocks, you would have made just over 10% a year. That's not bad at all. But you would have also had to endure seeing your account drop more than 43% in 1 year. During the same time period, if you invested 60% in stocks and 40% in bonds, you would have made just over 9% per year, which is also good. But the worst drop you would have had was only 26%, almost 20% less than the all-stock portfolio. And the next downside I see when it comes to having all your money in the S&P 500 index is the low amount of passive income. Now, you may not want passive income, and that's cool, but I know a lot of people want their investments to generate additional cash flow while they sleep. If you're investing in the S&P 500 index, it currently only pays 1.43% annual dividend. If you have a goal to be financially free, then passive income is critical. If you're investing $5,000 in the S&P 500 index based on the current dividend yield, after 1 year, you'd have only received $71 in cash flow. In the book Rich Dad Poor Dad, Robert Kiyosaki says, if I quit my job today, I will be able to cover my monthly expenses with the cash flow from my assets. It will be very hard to live off your cash flow if you're only making 1.43% in cash. A better approach may be to combine the index fund investment with real estate or incorporate a higher dividend strategy with your index investing. And lastly, I want to say take the time to understand and assess your specific goals, your risk tolerance, and your financial situation before investing in anything. You may see people posting about making a bunch of money in stocks. In addition, you may see a bunch of people posting about how index funds are a safe bet. But the money you've saved represents the time you put in. It represents time away from your family. It represents time that you spend commuting, meeting deadlines. And your investment decision should be taken very seriously. You work too hard to lose your money simply because you are following an investing strategy that wasn't the best one for you. So here are some questions that you should ask yourself to help you determine the best investing strategy for you. How much money do you have saved for emergencies? Before you start investing in anything, you want to make sure you have at least 1 month's worth of expenses put away. Because what will happen is, if you put all your money into investments, an accident or an emergency will happen, and then you're forced to sell that investment and you're starting right back at ground zero. So you want to make sure you have something put away for emergencies. And the next question you need to ask yourself is, how much money do you have to invest? All investments do not cost the same amount. So depending on how much you have to invest will determine where you can start. And the next question you have to ask yourself is, what investments do you understand? Because you want to make sure that you have wisdom and understanding of that investment before you put your money into it. And the next question, when will you need to start pulling out the money that you're investing? Because when you're putting money into a stock market, you need to make sure you have at least 5 to 10 years to let that money actually work. If that's money you're going to need in the short term, then it may be better to put it in a money market account or something like that. And then you have to understand, what type of returns are you looking for? If you're looking for 50% returns or 40% returns, then that's not very realistic. So you need to understand what the returns are you're looking for, and then what kind of returns do that investment offer. And then the next question, how are you affected by the price of your investments going down? As much as you expect to see your investment going up, you should also anticipate that that investment can go down by that same amount. And you have to understand, are you willing to handle that? And the next question, what is your strategy to actually stomach these investment declines? Meaning, how are you protecting against those drastic drops? So some of the stuff I talked about in this video, are you adding bonds to it? Are you adding real estate to it? Are you adding more high dividend stocks to it to kind of offset some of those declines? And the next question you need to understand, what are the fees associated with this investment? So one of the most expensive investments I see from clients that come to me is whole life insurance policies or index universal life insurance policies. And it's crazy that most people never even ask the question, what am I spending in fees? So that's very important for you to understand as well. And then the last question, how long has this investment been around? I typically don't invest in things that haven't been around for at least 10 years. And here's why. 10 years typically will allow me to see a full cycle in that investment. How it behaves during an up market, how it behaves during a down market. Because a lot of times things may be around for 5, 6, 7 years. But when those tough economies come around, that investment may be gone. So it's important that you understand, how long has this investment been around? As believers, we're encouraged to pray for a struggling relationship, a health difficulty, our sins. Today I want to encourage you not to be afraid to pray for wisdom on how you can become the prosperous person that God created you to be. There are evil, manipulative people out there that have wealth that you're supposed to have simply because they have the wisdom. The Bible tells us that a sinner's wealth is laid up for the righteous. Today I'm hoping that you believe that. Because if you take the time to seek godly wisdom instead of trying to chase riches, you're going to see a flow of abundance come your way. I believe it's in God's timing, but if you trust Him and you stay consistent, I truly believe you will experience a level of overflow that you never thought possible. So you do your part by welcoming God into your financial life and believe that He has wealth in store for you. Now, if you want to see more inspirational videos on a Bible-based approach to financial freedom, be sure to subscribe to the channel. And as always, thank you for taking the time to check out this video. May God bless you on your financial journey.